Greetings, everybody. This is Jeff Scott, and I've decided to re-record this. I've stuck an early version up on the website, but once I distribute it to a wider base on the HGSI site, not my Dropbox, I need to have the disclaimers. For those who are new to this series, I am doing a live meeting this weekend in Palm Beach. I have about 30 people attending. Many of the 30 folks are newbies to HGSI, and I wanted to ensure that they have a great experience. So this is, as I had promised them when they signed up, the 6th live session where I'm having the opportunity to discuss and teach HGSI the program and HGSI the trading philosophy. This is the sort of the culmination, somewhat of a review, and I term this the language of HGSI. If you are watching this and you're not part of our summit, I have placed the 6 videos as a service to those that trial and use HGSI to help them, and I will be offering at a nominal price a video recording, as long as it comes out, of my entire meeting. Let's get started. Make sure the recording is on. It's on. Disclaimer, as always, it's educational purposes only. Any recommendation in the spirit of education, not investment advice. I'm a doctor, not a broker, and most physicians lose money with their investments. And I'm not affiliated with any software vendors or trading company. I have paid for my software, and therefore I feel I am a good person to have limited bias to discuss the pros and cons of where you want to spend your money. Like many of you, I have invested over the last decade or more substantial dollars in various trading programs. Some have been more marketing than reality and hype, but I have come across in my travels some real standouts from an educational perspective and from a training. And I like to call them out because when you come to my meetings, you will see their influences on what I do every day and every night. Everything starts for me with this guy here, Ian Woodward, and his partner Ron Brown of Woodward and Brown Investing. I call this wall the Be Your Own Guru wall. And I remember back over 20 years ago, Ian coming to Atlanta, and Ian saying to me, and I can't do an English accent with a good voice, so it will be horrible here, Jeffrey, I am not a guru. I will teach you to be your own guru. And you know what? That's my philosophy. I'm not a guru. I don't pretend to be a guru. I've read a lot and studied a lot, and I think I have some pretty good knowledge base. But I want you to become your own guru, and if I can help you on that journey, then I've certainly accomplished what I intend to. Some of my major influences was Woodward and Brown. Ian's foundation really comes, I think, from learning from William O'Neill and then building upon it and making it better. O'Neill, really the godfather of growth stock investing, how to make money in stocks. It's worth a read on an annual basis. Morales and Kacher, ex-O'Neill money managers, now world-renowned authors and traders, introduced us to new things such as Bible gap ups and pocket pivots. Alexander Elder, Russian psychologist, came to the U.S., psychiatrist rather. I thought his books would be psychobabble. They're good trading psychology background, but they're great trading books. Great trading books. I've read them all, and we'll read his new one, which he's in press. This is Alex and Carrie, and I was able to attend a live meeting with them. When I talk about force index and MACD divergence, when I look at impulse indicators on charts as filters to take a trade or not, I did not make this up. This is stuff that I learned from Alex and Carrie. George Lee, good friend, Canadian, great trader. We trade differently, but we end up trading the same instruments and finding the same instruments. Good friend, we do a lot of Skype chats, and we did a meeting together in February in New York. We'll be doing one together in November. Stephen Bigelow is my candlestick guy. Minervini and Stein, nice books about how they too blew up accounts and learned how to trade and about their style. Dan Tharp, Money Management. And then let me just say a few words about something that's new on my board, and I'm actually kind of ashamed and embarrassed to say that it's new. I've been a customer of John Person since 2005 when I bought his indicators. I've read his books. And this weekend, I had the opportunity, where I took this picture with my iPhone, looks pretty good for an iPhone picture, to really listen to this guy for 2 days. He's a brilliant technical analyst. He's a trader. He's an author. He's been doing this since the 80s. And I learned a lot in 2 days, and it's made me go back and start to read his books again. And he'll be speaking at my meeting on Sunday this week. Can't wait. I'm not sure I'll be able to record his section. That will be up to him. When I talk about HGSI, it's a great community, and it really is three things. It's a software, it's a trading style, and it's a community of traders. Now, the software proprietor, George Roberts, he'll be at our meeting as well. He's a great friend of mine, and he's been a great resource, and he's added things at my request, like PSAR, MOBOs, squeezes, and I've given a host of other things that will help me in my trading. It's the trading style mindset of Ian and Ron, and now I guess I'll throw myself in a little bit as well. So I call it two brilliant minds in a retired doc. And then it's an active community of traders. And if you participate in our Yahoo forum, you'll know that there's certain names like Minkowski and Steckler and many, 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 many more, Gallardi, even sometimes mine, that when they post, it's probably worth reading. And certainly Ian's blog, and both when Ian and Ron post, and when Ron has his morning report, which is a paid service, it's also a great view of what's going on in the market. I love to teach. Not a surprise, teaching is an important part of medicine. First rule of medicine, though, is anything, whether it's a drug, whether it's a surgical procedure, whether it's a technique, it's a way of looking at something, must be reproducible to be valid. Black boxes that you can't really teach somebody else is not science in my mind. Medicine, and I think trading, the rules are taught by repetition. And in medicine, we live by the dictum, see one, do one, teach one. In medical school, you see one a lot. In internship, you do one. And when you become a resident, you teach one. Now, the second law of medicine is, and I kid you not, do not go to a teaching hospital in July or August. The reason is the transition from medical student to internship to resident is always July 1st. So you want to give the resident a few months under his belt, and the intern who used to be a student a few months under their belt before you go to the teaching hospital. This see one, do one, teach one is how I believe in teaching, how I approach education. My goal for the summit is for you to leave in do one stage and be prepared to teach one. I never will claim that I created the wheel or technical analysis. I'm not even an MTA. What I am is a student, a trader, and one of you that spent countless hours and dollars attending trading seminars and reading exhaustively on trading philosophy. I've been trading continuously and to some extent since the 80s. I have made every mistake in the book. I have blown up multiple accounts, none in the last decade, thank God. And it's my opportunity to take what I've learned, good, bad, and indifferent, from seeing and doing, and to teach you. And I can't leave this slide without recognizing the work of Ian Woodward, Alexander Elder, John Person, Ron Brown, John Bollinger, and the countless other gurus who I've had the chance to sit in the room like a sponge and take it as much as I can and use it in my trading. Now, at some point for fun, I'll share with you all the programs that I own. Then I'll talk about the ones I actually use, and you see them listed here. I've got to have a platform for trading. HGSI is my favorite platform from the perspective of analysis aftermarket, soon to have intramarket data. EdgeRater is complementary. I believe in seasonals. I was very excited to see how John uses seasonals, although I've seen that before, John Person. I like MarketSmith. But what's most important for me is what I've learned from my gurus. And again, as would it be in medicine, it's something I can repeat and teach over and over again across multiple platforms and various websites. Many resources are important to me. I'm not going to go through these today, but at my meeting, we're going to talk about how I use them, what I gain from them, which ones I'm keeping, which ones I'm getting rid of, and learning from you, the attendees, of what I should be looking at and what resources. I always learn from people I teach. So tonight, we're going to go through some critical HGSI principles and then talk a little bit about some of the unique indicators that we use, some of them harnessed from the masters, some of them taken by Ian and Ron and made much more powerful. Personally, I have built a toolbox over the years from reading, observing others, and attending the PV and other meetings. From HGSI and the community, I'm going to change the slide a little bit because I think John Person deserves his own line. I always do this on the fly. It's probably not very professional and doesn't come off well, but I like to be accurate. HGSI's harnessed Arms, Bollinger, Elder, Morales, and Kacher, Gang of Five, which I'm part of. We'll talk about the bongo, things that Ian has developed. John Person, Person's Pivots, PPS, High Close, Low Close Dojis, On Balance Volume. If you have TOS, you have those first two indicators. They are the most common indicators used on Thinkorswim. And then from George Lee, he's harnessed the power of David Elliott, may he rest in peace, John Carter, and others. I use multiple tools to target my favorite setups, pullbacks in an uptrend. I look for something that shows me a change in direction and momentum coming in. And once this is my setup, this is my trigger, this is something that I use as a confirming factor. And when my stocks fire, I jump. I use a lot of tools, a lot of indicators, but I have no analysis paralysis or no problem making a trade. As we go into some of the topics, first thing is market context matters. I am a top-down guy. I recognize that market drives the majority of the movement. Industry group about a third, which means about 20 to 30% comes from being a great stock picker. I'd like to think of myself as a great stock picker, but picking great stocks in bad markets is a way to lose money. Overall, the market determines my stance, long, short, big margin, little margin, all in cash. I try and identify the leading industries and find my favorite setups in them. I look at bottoms up for top stocks for short and long when the market forces are that way, and I use different tools to gauge what is working. I repeat this cycle wherever I do a meeting because one has to know where your stock and where the market is in the cyclical pattern for you to trade. I believe that HGSI offers some remarkably wonderful tools. For example, you've had a fall in the market, you've been basing. Well, sometime when the market fell, we have something called the bingo. The bingo is the baby out with the bathwater signal. It can fire on indices. It can fire on stocks. A single bingo does not mean anything. However, after a single or multiple bingos, I'm looking for a eureka, which we'll talk about. A eureka in HGSI world is analogous to O'Neill's follow-through day. It's a day that makes you stiffen up your backbone, recognizing that volume, advancing shares, ARMS index are lining up saying, buy, buy. As the market runs up, we look for signs of a top. Eureka's at a top after a big run-up could be a bad sign and could be a sign of emotion, of irrational exuberance. We look for the step brother of the Eureka, the Phoenix, again, determined by volume, advanced decliners, and ARMS index as a sign of perhaps a change in the market, something to make us further our commitment, our belief that the market is rolling over. At the top, we might look for things called Hindenburgs, evidence that the professionals are exchanging their shares with the individual investors, going from strong hands to weak hands, which we often see as the market tops. We look for kahunas to the upside and downside. So what I hope to do over the next hour, there's two parts of this recording, this is the first part, is to take you through the suite of HGSI indicators and how we use them to determine market direction, when to sit on the sidelines, when to be buying, and when to go short. I point out as well that this pattern is fractal. You will find it on monthly, weekly, daily, and shorter time frame charts. If you don't believe this pattern is true, look at dry ships. Go back about 5 years. Look at rig. Look at potash. Look at Walters Energy. Look at Cleveland Cliffs. And you're going to see all of them have that pattern. Several of them, like Walter Energy and Cleveland Cliffs, are still in the penalty box down here. Top down versus bottoms up. If most of the movement in a stock is driven by the market, I only want to go long when the market tells me to. Bottoms up, and you can read it at your leisure, just stop the tape. You know, there's more stocks, it's more sexy, it's more exciting, it's more fun, but I think it's much higher risk. In a rip-roaring bull market, I will look at stocks that are outside the top industries that are doing well. But in a market that's sideways or down, I rarely want to be bottoms up going long because I'm picking things that are not in the leading industries. Higher risk, more fun. Why tops down? This is an Ian chart, so I have to paraphrase the story. Ian used to hold a meeting every Saturday once a month on a Saturday in Palos Verdes. I actually went there, flew to California just to see his meeting. Imagine 20, 30 people sitting there, smart people, with the best teacher in the world teaching them. And one of the things that they do every month is they identify a list of stocks that they think are the leaders, the ones that they're going to win. And they do this month after month after month. Meanwhile, somebody is tabulating the results. They're dividing the months, whether it's a strong market, mixed strong, mixed weak, or a weak market, and looking at performance 20 and 40 days. What's not changing is the people and the style. What is changing is the market. What do you learn from this? In a strong market, attack. Go long. Go margin if you like. Because in a strong market, good stocks go up a lot. They had 106% average performance over 20 days. Now, the big move was over quickly, and it was only up 78% in 40 days, which is 2 months. In a weak market, the same people who were 106% up in a strong market actually lost money. Over a 2-month period of time, in a weak market, they were down 80%. When the wind is at your back, you make money. Don't fight the wind. You can make money going short, but don't be trying to make money going long in a bad market. Hindenburg-Omen, let me preface this to say Ian's become worldwide known because of this and his blogs. Norman Fosbach is a world-known economist who's involved in the development of this, and he's the husband of Myrna Fosbach, who's an HGSI user. I had the opportunity of having dinner with him in February. After having dinner with him, I'm not as convinced that this is a great signal as I was before, but I can't ignore the past, and it's still something that I follow, but I take with a grain of salt. The claim to fame, never been a significant stock market decline, not preceded by a confirmed Hindenburg-Omen. However, the majority of them are either false or small corrections. Here's a definition, or one of the definitions. This is a definition we use in EdgeRater and in HGSI, and you can see the critical thing here is you need confirmation. So a single omen by itself is probably not enough to make you start to change behavior. Here's a 20-year period of time. You can see how often these signals occurred. Out of 23 distinct periods, only 6 significant corrections, 34, 25, 24, 20, 16, and 38. The rest of the time, the corrections were much more modest. You can see, except for one here in 1998, most of the time, you see a number of signals in a cluster. Here is the market in 2006. April, here's one that may have woken you up, but by itself you do nothing. You don't sell because you see these. But when you start to see a series of Hindenburgs painting on your charts, you stiffen your back, you get out of margin, you start to raise cash, you start to think defensive, and you look for a reason, and that reason to me was a break of the moving average, either the 17 or the 50. This led to an 11% drop. Market then had a big run-up into 2007. As we got into June and July, market got a little bit volatile here. It almost looked like it broke out of a W pattern. And then all of a sudden, we're painting Hindenburgs all over. Another signal that a top was coming. Ample opportunity to get out. Pull back to the 200, and then we did it again in October and November of 2007. You notice you don't see this to the right. This was the beginning of the black swan. And those that took this signal and got out perhaps as the major indices crossed below their 50-day, or in worst case, their 200-day moving average, avoided quite a loss. The next topic is Ian's boxes. Ian has always given me permission to use his slides, and I always make sure that I credit the genius that created the slides, and that's Ian Woodward. And you can see this goes back to 1992. I'm a growth stock investor. Part of what makes a growth stock to me is earnings per share, and the more the better. What Ian has done is he's created a matrix looking at earnings percent the last 2 quarters compared to the prior year's 2 quarters, annual earnings over 5 years, and he's filled in the boxes over time with the stocks that meet those criteria. Often filtering by a level of earnings per share, relative strength, and group rank that picks the best of the best, maybe 240 or 80 as an average. And then at times of market reversals, you go fishing from these boxes. I point out box 7, which is my favorite box, and these are typically stocks that have great year-over-year or quarter-over-quarter earnings per share growth, but somewhere over the last couple of years, they stubbed their toes, and their annual earnings have dropped. Turnaround stocks. For argument's sake, here's Ian's boxes, better defined. Let me show you what happens. Ancient history. Ian Woodward, 1992-93. He's just showing you examples. But if you took all the stocks that met the criteria from September 11th to February 12th, a bottom to a top, 5 months, look at the returns. Box 1 up 59, box 2 up 40, box 5, 55, and box 7 up 47. Pretty impressive return over just a couple of months. Fast forward 98, 99. He used a filter, I think, of ERG 240 or 255. I can't remember. But he looked at all 190 stocks, not just the ones in these boxes. The average stock between October 15th and January 22nd, 3 months and a week, was up 67%. 94 box 1, 85 box 2, 102 box 7. That's kind of interesting. Fast forward, September 1st, 2010, top of the market or bottom of the market. Boxes were found. Filter was at ERG 255. And let's look at what happened. S&P between the bottom September 1st and top April 29th. So among friends, about 8 months. You can see that the S&P was up 24%. Box 1 was up 125, box 7 106, and box 9 up 50%. I like going where the fish are when I fish, don't you? Here's just graphically, you can see all the boxes did better than the S&P. How about last year, June 23rd, 2013? These are the stocks in the boxes, ERG 240 and higher. No one's going to buy them all, but let's assume that you did. The red ones don't exist anymore. The S&P was up 6.8%. The lowest box was up 9.1. Box 1 was up 14. Box 7 was up 12. Turns out box 4 and 5 and 2 were up the most, 25 to 30%. All of them, again, were up over the S&P. In fact, if you were a box stock, meaning you met the earnings requirement and your ERG was above 255, 240 rather, you had a 16% versus 6.8% of the S&P. EdgeRater gives me the ability to backtest. Now I remember 15 years ago sitting in Palos Verdes and people would question Ian and say, Ian, relative strength, you're cheating. The stock on October 23rd that has the highest relative strength, of course it's done the best for the year. That's why it's got the highest relative strength. Tell us what the stocks did at the beginning of the year based upon relative strength. EdgeRater lets me do that. So in EdgeRater, I can take a snapshot of the market. I had fundamentals from December 30th, 2012. And then I asked, what did the market do in 2013? All these answers are based upon the fundamental value at the end of 2012. So first thing is, when I look at ERG versus percent gain, I play Olympics, and I throw out the Russian judge on the left, the Cuban judge on the right, and only look at the center. The reason for that, this gray little bar shows you how few stocks are actually in the extremes of the ERG. And what you can see is a modest movement, higher the ERG, higher the return. And that's what you typically see. It's very compacted here and compressed, but the returns are huge. You see that EPS strength didn't matter that much, but there is certainly a hint that the stocks with the highest EPS rank outperformed, although stocks at the lowest rank, 2013, you did good even if you didn't make money. 2013 was clearly a year of relative strength, and stocks looking at relative strength on December 30th and then looking a year later how they performed, the highest relative strength stocks outperformed the lower. That isn't saying that the ones that had the highest relative strength on December 31st were the best in the year. It's saying the ones that were at the highest relative strength at the end of 2012 did the best in 2013. If you look at accumulation distribution in 2012 on December 30th, those that were A and B outperformed the rest of the year. So accumulation distribution lasted the whole year. And if you look at boxes, if you weren't in a box, this was your performance. Here's box 1, 2, 3, 6, and 7. So box stocks outperformed. Now what's fascinating to me, this year is different. Using data from December 30th of 2013, when I run my analysis through June 9th of 2014, the higher the ERG, the lower the performance. Stocks that were distributing at the end of the year have a higher performance than those that were accumulating. Relative strength hasn't mattered. In EPS rank, there's no pattern. The message there is this has been a non-trending year that has been difficult to make money, and it's been difficult to make money because you have tons of rotation and junk off the bottom, and what was leading one day is not leading the next. Now, I called the market low on the 13th on my webinar, and if you go back and see, you'll see my research and why, and I was correct, which is more luck than skill. But if I look at the market from April 14th to June 9th, cut out the ends because of the small numbers of stocks, you're back to left to right, rising performance based upon ERG. Earnings per share rank seems to matter again. Relative strength starting to perk its head up there. And the stocks that were accumulating now are starting to perform better. So perhaps we've changed to a more normal market. Time will tell. Ian's high jump bar, aka our own personal ATM machine. Learned about this a long time ago. I've done a couple of what I consider improvements to it. Ian's high jump says you take the price and you take the distance from the price to the 17, add it to the distance to the 50, and add it to the price to the 200. You combine that with the number and plot it. When you get to the highest point in the last, on the chart, 6 months, 8 months, you pick it, the market's going to pull back. A reversion of the mean indicator, a hyperextended indicator. And you could look at stock after stock. This is PEIX earlier this month or March. You can see how extended the stock got. And what did the stock do? It pulled back. Well, at this period of time, there's nothing higher to the left. That was extended. It pulled back. And you'll find this is uncanny. Gets extended, it pulls back. Extended, pulls back, and so on and so forth. This happens to be a great tool for knowing when it's time to take money out, put in protection, or use it perhaps as a filter to not go long on an overly extended stock. I've taken it one step further. I've created an oscillator, and then I hide much of it and just show you this line here. This line gives you a percentage reading, and you can define it better in TradeStation how many bars back. But I know that right here, Tesla was at 47% of its highest extension. Obviously, it's not extended. You could see how much higher it was up here, and I don't know what that number is, but it's pretty safe to say it's probably close to 100, and that would have given additional evidence that Tesla was overbought. The other thing that I do is I combine red candle highs, something that we learned from David Elliott, a failed new high, and I plot those, and a failed new high at the site of a high jump, which I can also scan for in TradeStation and Thinkorswim, gives me good reason to short or not go long or protect a position. Another concept that we talk about very often is free parking. I buy pullbacks and uptrends. I like to buy my pullback at the 50-day moving average. This is not the best example, except you can see it pulls back to the 50 and it runs. It pulls back to the 50 and it runs. It pulled back to the 50 and it failed. Now, I typically, especially when I'm not at my computer all day, I might, on this day here, I didn't, put a buy stop if it traded above and a stop right below the 50. So if it bounced off the 50 like it has done several times, I want to catch that swing. However, if it drops below the 50, it's breaking my rules and it's out. Free parking is the 50. Pocket pivots from Morales and Kacher. You can stop the video and read this. These are earlier evidence of a breakout. CanSlim is now practiced by hundreds and millions. I'm joking about that number, but by hundreds and thousands of traders. So the herd does CanSlim. So Morales and Kacher have written great books. They introduced us to new techniques such as pocket pivots, which are hard-coded now in HGSI. And these pocket pivots give you an indication of momentum and potentially a time to buy a stock or add to a stock. You can read the definition. Viable gap up is another one of their favorites, and it's a gap up that comes with buying and selling rules. Read their books. They're great tools, and we incorporate in our trading, and they'll be an important part of our meeting down here in South Florida. At this point, I'm going to stop the tape. I'm going to take a few-minute break, and we'll resume with part 2, which is what is a bingo signal. Thank you all for participating, and I'll be right back with part 2.